Fitch's U.S. debt downgrade was met with more than a little confusion by some. Former Treasury Secretary Larry Summers labeled it, quote, bizarre. With Allianz Chief Economic Advisor Mohamed El-Erian, he was puzzled. We spoke with him about it this week, and he asked a simple question.
Why now? What Fitch put in their statement has been true for a while. So why now? And that explains the reaction that I and many others have had, which is first, this is surprising. Second, when you look at the reason, you scratch your head as to the timing of this.
Another voice that's speaking out is Paul Krugman, the Nobel Laureate and New York Times columnist. He joins us now also with Yahoo Finance's Rick Newman. Paul, thank you for being here today. Just your reaction to the debt downgrade. You got the reaction by Mohamed El-Erian. What are your thoughts?
Exactly the same. I mean, it's, if you want to ask, does the U.S. have a long-run fiscal problem? Yeah, we have had some. It's not imminent. Our debt is still nothing like levels that we've seen in other countries in the past without any problems. But we do seem to have some, political deadlock that makes it kind of hard to get spending and taxes in line. But why none of that is worse now than it was a year ago when Fitch gave the U.S. a clean bill of health? It's a very, very puzzling decision.
Rick, you also wrote about the debt downgrade, and I don't know what your feelings are on the timing, but you seem to think it was justified.
Well, step aside from what the actual credit rating of the U.S. should be. I think what Fitch said accurately reflects the political dysfunction in Congress. I mean, you have a significant portion of the governing class in Washington continuously threatening to default. So if you're continuously threatening to default, why do you deserve a top credit rating? I mean, they only cut it by one notch. It's still just one notch below the top level. And Mohamed El-Erian says, why now? You could also say, why not now? I mean, maybe they should have cut it before the latest debt ceiling standoff, or maybe they should have cut it a year ago and they're just late. I mean, Standard & Poor's cut it in 2011. That was 12 years ago. So maybe it is the right time to do it.
And Paul, we just got the latest figures from the Bureau of Labor Statistics indicating more job raises. There was a little bit of a disappointment on the headline number, but for all intents and purposes, bullish numbers with respect to the U.S. economy, wage growth growing a little bit more than anticipated too. Your reaction, please, to the numbers.
Oh, I mean, the job growth was fine. It was actually high for an economy at this stage of the cycle, an economy that is at full employment, arguably more of a full employment economy than we've had for 20 years, to still be adding jobs at almost 200,000 a month is really amazing. And I think you want to just, it kind of bears on the debt rating also. If you were to go back to last year, lots of people were expecting a recession. Lots of people were expecting a sustained slump would be necessary to bring inflation under control. Instead, we have, immaculate disinflation, inflation coming down without any bump in the unemployment rate, with job growth still continuing, no hint of a recession, which, among other things, that's not the most important thing, but among other things, is good for deficits. It means that we don't suffer the revenue losses that go with the recession. So no, this was really a kind of a Goldilocks jobs report.
And Paul, as you wrote in your most recent piece, spending, for lack of a better term, is good. In other words, spending perhaps would have helped us more bigger spending perhaps would have helped us more after the financial crisis, and spending, government spending that is, has put us in that Goldilocks position where we are today, you would argue. So how then do we contend with the debt part of that equation? When and if and when that presents a problem, what would make it be a problem?
Well, first of all, I mean, spending is good when the economy is depressed. The economy is not depressed now, so we don't need fiscal stimulus right now, and that it wouldn't hurt if we could find some way to, raise more revenue, cut back. I'm not sure exactly what we're going to cut back on, but it's not a crisis level thing. But this is not. We don't need extra stimulus now the way we did, arguably, even when Joe Biden took office. But if we're sort of trying to think Forward, I think in the end we are going to have to reconcile, what the public wants, which is Social Security, Medicare, Medicaid, with the raising enough revenue to pay for it. But nothing urgent, nothing imminent.
Paul, there's an obvious challenge to the Biden White House, which is that his popularity is really not moving, even though we have a very strong labor market. We've had a nice stock market rally this year. Inflation is coming down. We may actually be heading for a soft landing. Do you understand why Americans don't seem to be giving President Biden much credit for this? And do you think that's going to improve over the next year or so?
I mean, the short answer is God knows, right? I mean, it's it is really kind of mysterious, but it's not. If you looked at multiple surveys now where you ask people, how are you doing? And they say, fine. And you ask, how's the economy doing? And they say, it's terrible. And somehow or other, blame the media, blame partisanship, just somehow it's also not entirely clear that that's, people will actually vote on that basis. Remember, the midterms were supposed to be a Democratic wipeout because of inflation, and they weren't. But it is really kind of weird. I mean, lots of people think we're in a recession when, in fact, we're in an extraordinary jobs boom. Lots of people think inflation is accelerating. But this happens on other issues, too. During the epic decline in crime that took place between around 1990 and 2015, steadily through that whole period, people said crime is increasing. So the idea, we are somehow in a nation in which people are doing fine, experiencing good conditions, but are sure that really bad things are happening to somebody else whom they happen not to know.
I mean, I think one could argue that when it comes to inflation, if the pace of increase is less, I'm not tracking it if I'm buying stuff by the pace of increase, right? I just know I'm spending more on this thing than I used to be spending. I'm not tracking it by percentage or maybe even dollars. It's just more of a feeling, right? I mean, and this is something that Rick has sort of pointed to in the past as well, that perhaps all of this public sentiment is pegged more to that price vibe, if you will, rather than anything else.
Well, I mean, historically, if we think about, if you go back to the last time we had a major inflation, people gave Reagan a lot of credit for, not necessarily correctly, but people gave him a lot of credit for having brought inflation under control. But, prices never came down. It wasn't as if the level of prices went back to its level from the mid-1970s. It was just that the rate of increase came down. So why should the rules be different now? That's really does not make a lot of sense. What I will say is, and to some extent in defense of public perception, the resurgence of inflation did come as a big shock. People were not, had started to not think about inflation, or actually hadn't been thinking about inflation for a number of years. And so then all of a sudden we get about 18 months of serious inflation, which was not on anybody's, dance list. And that is a shock. I think it wears off over time. Whether it's in time for the 24 election, we don't know. But, but that's the best explanation I can give, aside from the fact that, well, if you were watching not this news source, but certain other major news sources, you aren't hearing any of the good news about the economy.
Well, we try to be fair there with respect to that. I want to draw the viewers' attention to a chart, and you've been writing about this recently. I'm a fan of technical analysis, and this chart has a pattern which I haven't heard described before, but it makes sense, a frying pan. And if you squint there, you'd have to draw in some lines. Basically, we were on a certain trajectory before the global financial crisis, got knocked off a little bit, but now with the pandemic, we've accelerated again, and maybe we're back on track. Just give us your breakdown, please.
Yeah, I mean, what we had during the aftermath of the last crisis in 2008 was a sort of silent economic disaster. We took a long, long time to recover, both in terms of employment, in terms of output, to the pre-crisis trend. It was trillions of dollars of wasted, of stuff we should have produced that didn't, millions of person years of employment that we should have had that we didn't have. This time around, People complain about the inflation. People say Joe Biden overdid it. But the fact of the matter was that faced with a horrendous crisis, we staged a record fast recovery. And we're now, by a number of measures, we now have either the closest to a true full employment economy that we've had since the year 2000, or maybe the closest to a full employment economy we've ever had. So this is a big difference. The reality, if you look at the numbers, is that we've actually had it's a wonderful life. We've actually had a terrific economic recovery.
Paul, these three bills that Biden has signed during the last 2 years, infrastructure, semiconductors, and green energy, this is a lot of money that's now starting to flow into the economy. The uptake on the green energy subsidies is more than a lot of experts anticipated. Is this going to move the needle in terms of perceptions about the manufacturing economy in the United States? All the hollowed out towns that and those voters that Trump has been successfully appealing to. Is this going to change things in the heartland or in those parts of the country, or is it not that significant?
No, it's pretty significant. If you look at manufacturing construction spending, which is sort of the number that comes in first, the other thing, actual manufacturing employment, will lag behind it. It's just gone vertical. We've just had a extraordinary increase. So these policies have definitely given a major boost to manufacturing. Now, that's not going to bring us back to the old days when manufacturing was, a third of employment. It's still going to be relatively, we're still going to be a service economy, but we are seeing what looks like a manufacturing revival. And all of this also probably, I think of there being sort of four factors that have helped us avert the recession that everybody was predicting. It's the infrastructure bill, the CHIPS Act, the Inflation Reduction Act, and Taylor Swift.
All of those things make sense to us, and we've talked about all of those on our program. Did you go see Taylor Swift?
No, I've heard stuff is fine. I have nothing against it, but mega venues are not my thing. I like the 500-person venue or the 200-person venue, not 80,000.
Yeah, I sympathize. I share that view. Thank you so much, Paul Krugman, Nobel Laureate and New York Times columnist, our very own Rick Newman. I don't think he's a Swiftie either, but we'll talk about that offline. Thanks to you both, gentlemen, very much.